This video is created by Jagrat Creations. It is on Hire Purchase and Installment sales transaction. I want to solve one sum here before you. Just observe the sum on the screen. This is the sum that I intend to solve here before you. Anil purchased a machinery on 1/4/2013 from Kishore on hire purchase basis and paid rupees 20,000 on that day. So down payment is 20,000. He paid remaining amount including 10% in interest in installment as under. So this 35,000 is the first installment paid, which includes the principal sum as well as the interest element. The second installment paid on 31/3/2015, that is after 2 years from 1/4/2013. So 32,500 paid. That includes the principal sum, part of the principal, and the interest till the date. On 31/3/2016, 30,000 is paid. That includes part of the principal sum or part of the cash price is paid and interest till 31st of March 2016. And in this last installment 27,500, that includes principal sum as well as the interest element. So all these installments are given to you with interest element. Machine is to be depreciated at 10% by diminishing balance method. From the above information, prepare in machinery account and Kishore account in the books of Anil purchaser, and in the books of Anil prepare the account of Kishore. So this is a question that has been asked. Now in this sum, notice that I am given the interest rate. I am given installment with interest. I am not given cash price. I am given down payment. So I am required to find out the cash price first of all. Because if I know the cash price, then and then I can debit machinery account. And so long as I don't know the cash price of the machinery, cash price of machinery means what? If this machine is purchased, otherwise then installment, how much upfront payment is to be made to acquire the ownership of the machinery, that is identified as cash price. So I am required to find out cash price of machinery first of all. For that, I prepare one working note. Just observe. Now for the purpose of finding out the cash price, I will start with last installment. Why I start with last installment, that also I am going to explain to you. So, last installment is 27,500. And the payment of this fourth installment is made on 31st of March 2017, 27,500. So by payment of 27,500, nothing is outstanding. This is the last installment. Last installment means total payment is made. So by payment of 27,500, no amount is outstanding. So this 27,500 is an amount wherein principal plus interest is there. But the interest is for only 1 year, and that too at the rate of 10%. Now suppose that 100 is the amount outstanding at the beginning of the year 2016-17. Then 10 is the interest. 110 is the amount total payable with interest. Installment amount payable, installment amount with interest payable will become 110. So if 110 is the total amount payable with interest by way of installment, 110 is the total amount payable, then 10 is the interest. How much for 27,500? So to find out the interest element, I am required to multiply 27,500 into 10 divided by 110. So let me go for interest calculation. So 27,500 into 10 divided by 110. Once again, this is the last installment. After that, nothing is outstanding. So no further interest is payable. Here the last annual interest is paid. Last annual interest is paid at the rate of 10%. On what principle? Say 100 is the principal, then 10 is the interest. 110 becomes the installment. So if 110 is the last installment, then 10 is the interest element. How much for 27,500? So 27,500 into 10 upon 110. So interest element is 2,500. So 27,500 minus 2,500. So principal amount paid in the fourth installment is 25,000. The amount paid in fourth installment, principal amount paid in fourth installment is 25,000. Now notice it. This 25,000 principal amount that was unpaid at the beginning of the year is paid at the end of the year with interest. So 25,000 principal amount paid at the time of last installment. Now the question is, when this amount is paid on 31/3/2017, is this 25,000 outstanding, unpaid on 31/3/2016? The question is, the outstanding amount 25,000 principal sum paid in the last installment 25,000. That was outstanding. That was paid on 31/3/2017. So 25,000 outstanding amount paid on 31/3/2017. Now my question is, do you find that this 25,000 were outstanding on 31/3/2016? The answer to the question, yes, it was outstanding. So, when you have calculated interest for an installment as on 31/3/2016, the interest is calculated not only on the principal sum paid on 31/3/2017, but it was also paid on this outstanding amount. So, the third installment, 30,000, paid on 31/3/2016. Now, this 30,000 is the installment amount with interest. Here there is 10% interest is already included, but 10% interest is included on what principal sum? So this 30,000 is the amount with interest. This 25,000 is the principal that was outstanding on 31/3/2016. So if you want to apply this 10 upon 110 logic, if 110 is the total installment, then 10 is the interest. How much is the total amount? So this 30,000 plus 25,000, 25,000 outstanding paid on 31/3/2017 were outstanding on 31/3/2016. So on this 25,000 you are also required to pay interest for 16/17. On this 25,000 you are also required to pay interest for 15/16. So when 15/16 interest was calculated, this 25,000 unpaid amount, but that has been paid on 31/3/2017, has also played a role in calculation of interest. So 30,000 plus 25,000, 55,000. So 55,000 is the total amount with interest outstanding as on 31/3/2016. If 110 is the outstanding amount, then 100 is the interest element. How much for 55,000? So interest element here is 5,000. So 30,000, 5,000 is the interest element. So in the second installment, the principal paid was 25,000. So in this third installment, principal paid 25,000. In this fourth installment, principal paid is 25,000. So before payment of this third installment, total 50,000 were outstanding. And on 50,000, if you calculate interest at the rate of 10%, it will become 50,000 into 10%, 5,000. This is how interest is calculated. Now, I want to find out the interest element in this installment, second installment, 32,500. Now, once again, the same question. This 25,000 paid on 31/3/2016. This 25,000 paid on 31/3/2017. So, this 50,000 were outstanding as on 31/3/2015. So, when the payment was 32,500 was made, after making a payment of 32,500, the amount outstanding were 50,000. So when the interest calculation was made in this 31/3/2015 installment, this 50,000 has also played a role for the purpose of computation of interest. So this is the second installment. Now you have to find out the interest element in this 32,500. So 25 plus 25, 50,000 plus 32,500. Is the total amount outstanding with interest. And when it is a with interest amount, so that is equivalent to the base level is 110. If 110 is the outstanding amount with interest, then 10 is the interest. How much for? 82,500. So 10 upon 110, that works out to be 7,500. So 32,500 minus 7,500. So principal sum paid in the second installment is also 25,000. Now the question arises, when the first installment was paid, was this 25 and 75,000 were outstanding? Yes, they were outstanding because at the time of the payment made of first installment 35,000. After that, second installment paid, 25,000 outstanding paid. Third installment paid, 25,000 principals are paid. Fourth installment paid, 25,000 principals are paid. So the 75,000 were outstanding after payment of 35,000. So 35,000 was the payment made. After that, 75,000 were outstanding. So amount with interest was 35,000 plus 75,000. So 35,000 plus 75,000 into 10 upon 110. So you will get the interest element to be 10,000. 35,000 minus 10,000. 25,000 is the principal sum paid. So total principal sum paid by way of 4 installment is 1 lakh. Down payment made is 20,000. So total cash purchase price is 1,20,000. This is how cash purchase price is worked out. This is a very important calculation. When you are given installment with interest, interest rate is given to you and cash price is not given to you, you should start from the last installment. This is an important point to be understood by the students. Now let me calculate the depreciation on this cash price, 1,20,000. Depreciation is the rate of 10% on diminishing balance method. So let me work out depreciation for all the years. So 13-14 depreciation at the rate of 10%. 12,000. Closing balance 1,08,000. That becomes opening balance for 14-15. Once again, depreciation at the rate of 10%, 1,08,000, 10,800. 1,08,000 minus 10,800, 97,200. That becomes opening balance for 15-16. Once again, depreciation at the rate of 10% by diminishing balance method, so 9720. So here I am going calculating the annual depreciation which I am going to consider while preparing the ledger accounts. So 97,200 minus 9720. That works out to be 87,480. Now 87,480, 10% thereof, 8748. So this is the written down. So this is a working note for depreciation. This is a working note for interest calculation and finding of cash price. Now after preparing this working note, I want to prepare ledger accounts as question 2. So in the books of Anil Purchaser, I prepared 2 accounts, machinery account and vendor Kishore account. First of all, the machinery is purchased for 1,20,000. So machinery account debit to Kishore account credit. Machinery account debit to Kishore account credit. Here the machinery account is debited and Kishore account is credited. Now down payment made 20,000. On the same day, Kishore account debit to bank account credit. Kishore is the receiver, debit the receiver, Kishore account debit to bank account credit. Now take care of first installment. In first installment, interest 10,000. So I write the entry for the first year only. So interest account debit to Kishore account credit. Interest is my expense. Because on outstanding amount I am required to pay interest. Interest is my expense. Expenses are debited. So interest account debit and that is payable to Kishore. So interest account debit to Kishore account. Now the installment paid 35,000. Kishore account debit to bank account credit. Now I am required to provide depreciation. Depreciation account debit to machinery account credit. And this interest and depreciation are transferred to profit and loss account. So 10,000 plus 12,000, 22,000. Profit and loss account debit to depreciation to interest account credit. This is how the journal entries for the first year are recorded. After that, I would like to close the accounts. Here I have not prepared depreciation account and interest account. Because it is not questioned. Now after writing these things, let me write down the closing balance that becomes opening balance. So this is how the machinery account operates. Now very simple way to prepare machinery account now to complete it. Credit depreciation to machinery account. Here this is the Kishore account. Closing balance 75,000, that becomes opening balance. Now after, see I have recorded journal entries for the first year only. And I have prepared machinery account and Kishore account is also prepared by me. On the basis of journal entry. Now, I want to complete this machinery account. The depreciation will be credited, depreciation account debit to machinery account credit. Balance of machinery will be carried forward. That balance of closing balance of machinery will become opening balance in the next year. This process you have to continuously, you are required to continue with that process for next 3 years. So, look at it. Depreciation account debit to machinery account credit. Find the closing balance. That becomes opening balance for the next year. Once again, depreciation account debit to machinery account credit. Find the closing balance. That becomes opening balance for the next year. Depreciation account debit to machinery account credit. Find the closing balance. This is how machinery account gets concluded in examination. Now I want to complete this Kishore account. I am required to pay interest to Kishore. So interest becomes payable to Kishore. So interest is my expense. Interest account debit to Kishore account credit. And Kishore account debit to bank account credit for installment being paid. So let me start with second installment. 7,500 interest. Interest is my expense. Interest account debit to Kishore account credit. Installment paid 32,500. Kishore account debit 32,500 to bank account credit. Now find the closing balance. Closing balance is 50,000. That is equal to these two installment principals. 50,000. That becomes opening balance. Now take care of third installment. Interest payable 5,000. Interest is my expense. Interest expense account debit to Kishore account credit. Installment paid 30,000. Kishore account debit to bank account credit 30,000. Find the closing balance. That works out to be 25,000. That becomes opening balance on 1/4/2016. Now fourth installment. Interest payable 2,500. Interest account debit to Kishore account credit. Installment paid 27,500. So Kishore account debit to bank account credit 27,500. By writing journal entries in the ledger posting in this fashion, you can close the account and the Kishore account gets closed. This is how the vendor account is prepared, and here I have prepared machinery account. So machinery account, vendor account is prepared. I have not prepared depreciation account and interest account. Even if you want to prepare depreciation account on annual basis, all this depreciation will be debited every year to the depreciation account, and the depreciation account gets transferred to profit and loss account. So depreciation account will be credited by profit and loss account with the transfer entry. Similarly, if you want to prepare interest account, this is the details of interest account. First year interest debited 10,000. Interest account is debited with 10,000 in the first year. In the second year, 7,500 will be debited. In the third year, 5,000 will be debited. In the fourth year, 2,500 will be debited. And every year, the interest expense will be transferred to profit and loss account. So interest account is credited by profit and loss account by transfer entry to profit and loss account. This is how you can prepare depreciation and interest account. Now on the basis of same sum, I want to write in the books of vendor. So Anil is a purchaser, Kishore is a vendor. Now I want to write the ledger account in the books of vendor. So books of vendor, Kishore. I sold the machinery to Anil. Anil has committed to make me payment in installment with interest. So I am going to prepare only Anil account. In my books, machinery is already given to Anil. So depreciation will be provided by Anil on that machinery. So there is no corresponding entry for depreciation in the books of vendor, because vendor don't get the claim for depreciation because he has already transferred the machinery to the purchaser. So here only purchaser account is to be prepared. So first entry I would like to write down. Who is the purchaser? Anil. Anil is a receiver. Debit the receiver. Anil account debit to sales account credit. So Anil account is debited with the sales account. Down payment receipt 20,000. Bank account debit 20,000 to Anil account credit 20,000. Anil is a giver. Credit the giver. So Anil account is credited with 20,000. Now by the end of the year, interest become receivable 10,000. Interest is my income. Remember, I am a vendor. This is the amount recoverable. So interest is my income. Incomes are always credited. So interest income account is credited. The amount is to be debited to Anil account. So Anil account debit to interest account credit. Installment received 35,000. Bank account debit 35,000 to Anil account credit 35,000. After that, strike the closing balance. the closing balance is 75,000. That is equal to total of these three, 25, 25, 25. This 75,000 is the closing balance. This closing balance 75,000 become opening balance, debit balance, recoverable amount, debit balance. So that becomes opening balance. In the second year, the interest income is 7,500. So, annual account debit to interest account credit, 7,500. And the installment received, bank account debit to annual account credit, 32,500. Now strike the closing balance, it should be 50,000. Total of these two principal sum, 50,000. That becomes opening balance in the next year. In the third year, the interest recoverable 5,000. It's an income. So annual account debit to interest income account credit. The installment received 30,000, bank account debit 30,000 to annual account credit 30,000. Annual is the giver, credit the giver. Find the closing balance, that works out to be 25,000. That becomes opening balance at the beginning of the last fourth year. Now once again, interest recoverable 2,500. So annual account debit to interest income account credit. And the last installment received 27,500, bank account debit to annual account credit. So this is how total amount is recovered. This account gets closed 27,500 and 27,500. This is how Anil's account is prepared in the books of vendor. Purchaser account is prepared in the books of vendor. There is no corresponding entry for depreciation in the books of vendor. That's an important point to be noticed by the students. So I have tried to explain you this sum. I feel that you have followed all these things. Thanks to you.